Hi everyone, welcome back to class.
Evening.
Yeah. In financial modeling, there is a professional standard we need to follow because financial modeling is a profession, just like every other profession. In accounting, we have the International Financial Reporting Standards, right? And every other profession, we have standards that you must follow to make your reports easier to be understood or usable by the stakeholders. In financial modeling, we have an acronym called the FAST standard. And the letter F stands for flexible, A stands for appropriate, S stands for structured, and T stands for transparent. And I'm going to open a PDF file where from the FAST standard website. So the FAST acronym, F represents flexible, and when we say your financial modeling should be flexible, it means it should be able to accommodate changes, maybe in the now or in the future. Somebody should be able to run scenario analysis, sensitivities, and the rest. So at the same time, when we say that your financial model should be flexible, it doesn't mean it should be a one size fits all. It doesn't mean you can take a financial model for a financial institution and use it for and oil and gas. It means that it should be flexible for the purpose you are building it. Appropriate, letter A, appropriate. When we say a financial model should be appropriate, it means that it should not have ambiguous information. It should not be cluttered. It should not have unnecessary detail. It should just have as much information as possible to make it clear for the users of the financial model. And when we say financial model should be structured, it means that the outlook should be consistent. The various worksheets in the workbook of your financial model should look consistent. They should look clean and consistent. Then also the formulas should be easy to understand, especially by financial modelers and the users of the financial model. And when we say the financial model should be transparent, it means that it should be understood by the financial model should be clear and the formula should be easily understood by both modelers and non-modelers. Right. So there should be no ambiguity, no hidden, no hidden figures. If you want to hard code numbers, they should be in the inputs section of your financial model, or else the financial model should be transparent. When somebody audits your financial model, they should see the logical flow of the financial model. That's basically what we have under the FAST acronym. So the next thing we'll be looking at will be the drivers in financial model. Now, when we talk about drivers, these are basically the key variables or parameters or factors of the line item. So when we say line items, they are those things you see when you open your financial model, especially the three statements. The income statement has line items. The line items of your income statement are the sales, the cost of sales, and the rest. While the line items on our balance sheets includes the non-current assets, which includes the property, plant, and equipment, the long-term investment, and so on and so forth. While on the cash flow, we have the different segments of cash flow, right? So each of those line items, especially the income statement and the balance sheet, have drivers or things that we can use to predict them. So I'm going to open an Excel sheet and we are going to see how to apply these drivers in our financial model. Let me see, do I have it open? Okay, stay with me. Mm. Now, I'm going to give an example before I go into the different drivers for the line items. For example, when we mention drivers, let's talk about revenue. Revenue is the first line item on our income statement. Now, what is revenue? Revenue is another word for sales, right? What makes up our revenue? Basically, what makes up our revenue is our price, price, and what's quantity. So it means that if you want to build a model and want to project the revenue, that means we must know what is the price of that particular revenue, the company's revenue we want to project, right? For example, if price, let's say 100, and this company is producing, let's say, or selling, um, let's say 2,000 items of this particular product. It means that revenue is simply price times quantity, right? It's as simple as this. So we must be able to know the price and the quantity to be able to project the revenue of a company. That means price and quantity are actually the drivers of revenue. Now let's now go into the different drivers in our income statement. So let's see, what are the drivers of our income statements? Oh, wow. Uh, So when we are on our income statement, we have different line items, and these are the line items I talked about: the revenue, cost of sales, gross profits, sales, general and administrative expenses, EBITDA, depreciation, amortization, and the rest, till you get to your net profits. So for revenue, let's see, what are the drivers? We've already talked about the drivers for revenue, and we said that the driver for revenue. Can you hear
Sorry
me?
to interrupt.
Okay.
I can't see your screen.
Really?
Yes, I don't know if it is from my end alone. I can't see your screen.
Sorry, Faith, confirm if you can see my screen.
Yes, I can. Sorry. Yes, I can see it.
Okay. So maybe you should
Let me
log
and
out.
rejoin.
Yeah, rejoin, please. Okay.
Okay, I can see it now. I think it's my
Wow.
network.
Awesome, awesome. That's good. Okay, so we have our revenue. I want to see what are these things that when we have their values, it will help us to project or to know the value of our revenue. Another way to look at drivers is when you actually zoom a particular line items, what are the components of these line items? Right? And we said that for you to get revenue, you need to know the price and you need to know the quantity. Let's say you are projecting revenue from the scratch, right? Now, another way to project revenue is if you don't have the actual figure of the price and quantity, and it's a maybe a company that's already in existence, they have historical figure, you can actually know, let's say you can use a growth rate. You can look at their historical growth rate and know how has the revenue been growing before, or what do you think, we can use to grow the revenue. Another thing to use to project the revenue is the capacity, especially for production companies, capacity, or maybe a fintech company and they have a maximum capacity of maybe transaction they can process in a day or in a month or in a year. So that capacity can limit maybe the quantity or the volume of transactions they can process. Right? So capacity is one of the drivers of revenue. also demand for that product, that's the number of sales you are making, can also drive revenue. I believe that's understandable. Now, the next line item on our income statement is cost of sales. Now, for cost of sales, what can really drive cost of sales? We want to know the cost per unit of those items that make up the cost of sales. So we are going to know the cost per unit, right? If it's let's say your prepaid meter, electricity meter, you want to know what is the cost per unit of your subscription, right? Or maybe any other thing that makes up your cost of sale, maybe the raw materials. You want to know what is the cost per volume of that raw material. You understand? So another thing that can make up is the quantity, of course. Let's say the quantity of the raw material you are buying, or yes, basically the quantity of raw material you're buying can, once you know the quantity, you can use it to drive it, right? What else? If you don't have all this specific information, you can use percentage of the revenue compared to revenue. So when we know how much cost of sale is compared to revenue, right, especially from the historical performances or the historical figures, then we can use it to, drive the cost of sales. Now, gross profit is just like a summation or an arithmetic line item that says revenue minus cost of sale is gross profit, basically. So we don't need any drivers for that. So if you had put any driver here, you are wrong. So, but don't worry. So sales, selling, general, and administrative expenses. These are basically expenses that we use to, of course, it's very obvious selling, general, especially overhead costs, right? And administrative, like salaries of administrative staff and the rest of them. Then we need to know what are the drivers. So basically, you need to know what are the monthly operating costs, right? You want to know what are the salaries, those staff that you have, what are their salaries? What is the monthly operating costs? You want to know what is the monthly operating costs? Maybe cost of diesel, any other thing that's just general. Then what is the rent? All these things are part of the selling, general, and administrative expenses. The utilities, and so on and so forth. Then if you don't have these figures, you can just project it using the percentage of revenue, right? So EBITDA is just like another arithmetic line item that has to do with the full meaning of EBITDA is earnings before interest, taxation, depreciation, and amortization. So you just say gross profit minus the SG&A to get your EBITDA. Now, the next line item in our income statement is depreciation. Of course, we know what depreciation is, and for you to get your depreciation, the drivers are the fixed assets that you have. The fixed assets in our company, in our books. Then if, of course, another way to get to get information that we use for depreciation is, let's say we have use of funds. For example, a company can raise funds and they want to use it for acquisition of fixed assets, maybe for expansion and the rest. So that figure, when we get that figure, then we'll be able to use it to calculate depreciation, right? Another thing is we need to know what is the lifespan of the assets, and we need to know the depreciation rates. The depreciation rates. how many years, okay, the lifespan has to do with how many years the assets will last for, and what is the depreciation rate, right? What are we using, what kind of depreciation are we using? Is it reducing balance? What is the rate, right? So if you have your depreciation rate, you'll be able to calculate your depreciation. Amortization is just like depreciation, but in this case, it applies to intangible assets. So you need to know what are your intangible assets. Intangible assets, right? Then you also need to know the lifespan of the you need to know the lifespan of the particular intangible asset, and you need to know the rate you want to apply to the amortization, right? So EBITDA, earnings before interest and tax, is gotten when you less depreciation and amortization from EBITDA. So the next line item is our interest income. Of course, interest income. The line items or the drivers that drive interest income includes, you need to know what are your cash deposits. Most times company earn interest income from their cash deposits, right? It might be a fixed deposit. No, you cannot, most times you don't keep your cash lying fallow. You want it to earn interest, right? You want to know there are some other investments that are not maybe part of the core revenue of the company, but they might invest their cash. What is the rate? What is the rate that they are getting for any deposit or investment they've made? That will help us to drive our interest income. Now, the next one is interest expense. Interest expense occurs when you have loans. So you need to know your loans. When you take loans, you pay interest, right? So also if there's any lease, if there's any overdrafts, overdraft or revolver. Another word for overdraft is revolver. Then what is the rate we are paying, right? So those are the drivers of our interest expense. Another line item we'll talk about in income statements is our tax expense. So for you to know your tax expense, you need to know the profit before tax. If you don't know your profit before tax, you won't be able to, drive the tax expense. Then what is the tax rate, the prevailing tax rate? So basically, these are the major drivers of each of these line items of our income statements. So the next one we'll look at is are the line items of our balance sheet or statement of financial position. In our statement of financial position, we have current assets and liabilities and equities and the rest. So for the line item called PPE or property, plant and equipment, what are the drivers of property, plant and equipment? It's basically the fixed assets, right? We want to know what is the fixed assets that we have, or what is the use of funds. The funds we want to disburse or we've gotten from our investors, what do we want to use it for? Do we want to use it for acquisition of properties, plant and equipment? Then also our intangible assets is the same drivers for this, even though we know that our intangible assets are non-physical, right? So for our long-term investments, we actually know this from maybe the management information. Management, we want to decide, okay, what are we what are we investing in the long term, right? So the company management or the board will decide long-term investments, right? So for our current assets, inventories are driven by the now after now or maybe in our subsequent classes we'll discuss the operating working capital. So inventory is part of our operating working capital. So we want to know what is the number of days, of our inventory. So we'll say number of days, e.g. 30 days, right? Let's say we want to keep our inventory for 30 days or our inventory lasts for 30 days, right? So these are the things. And basically, you can get your inventory from, so I'm going to expand this column. Yes. So I'm going to move this. So another line item that can help us know our inventory or value of our inventory is cost of goods, especially when we don't know, when we want to project our inventory, we want to know, okay, what is the cost of sales? So we are going to go over how we are going to, derive our inventory from the cost of sales. Right, then the next thing we want to see is the trade receivables. This is also under our operating working capital, right? So you want to also know what is the number of days of trade receivables. Most times, maybe you want to reduce your number of days of trade receivables, maybe to like 20 days. And receivables is always from your revenue. If you don't make any sales, you won't have any receivables, right? So what about prepayment? This also an operating working capital concept, right? And you can predict it or project it from the number of days. Prepayment, most times, okay. So we are going to go over this concept and we are going to understand how we are going to project our prepayment from number of days. And prepayment is basically a concept under our sellings, general and administrative expenses. So cash and cash equivalent is basically from our cash flow statement. Yes, we get this is linked from our cash flow statement. Now, under equity, we want to know what is our equity contribution. What's our equity contribution or the equity contribution of the shareholders? Retained earnings, of course, is from our income statement, right? We want to know what is the previous retained earnings, what is the profit after tax, and the rest. A whole of other drivers drive our retained earnings. Then, under our liabilities, our loans and borrowings, we have sources of funds, just like that. We want to know, did we source some of our funds from debts? That is loans, right? So when we take loans, it will actually affect or drive our loans and borrowings. So what else? Under current liabilities, the trade receivables, is this is an operating working capital concept, just like the other ones up there. Then our accrual is also an operating working capital concept, just like this one. So the same thing applies to this, right? Then tax, want to know what is tax payable, what is the tax due, what is our tax due, right? So going back to these trade receivables, right? So trades payables, sorry about that. Trade payables. Trade payable is basically under our cost of goods sold, right? When you buy, when you purchase raw materials and the rest, because you purchase on credit, you have to, it's a trade payable because it's a short-term, liability, right? So accrual is basically under SG&A. Maybe you have made an expense and you are yet to pay, you know. So one thing that can drive it is the SG&A. So basically, these are the major drivers under our balance sheets. And I believe that when we want to build our financial models, we can have this at the back of our mind so that we will be able to make a very, very precise and logical financial model that is flexible, right? Because if you don't know some of these line items, your financial model will not be flexible. It might not be appropriate. We've gone through all these financial modeling standards. So knowing your drivers will help you to be conscious of this or to take note of the financial modeling standard and to actually apply them in your modeling. Okay, I think we've come to the end of our class. I am open to taking questions right now.
Just
Hello?